Hey everybody, welcome back to Jen's Wealth Crypto, where we make the complexities of crypto simple. Today, we re-diving into crypto loans in 2025.
What if I told you that you could get cash today without selling your Bitcoin or Ethereum? It's exactly what crypto loans make possible. In this video, we'll break down how crypto loans work, the platforms offering them in 2025, the risks, the benefits, and everything you need to know before using your crypto as collateral.
Whether you hold Bitcoin, Ethereum, or altcoins, this guide will help you understand how to access liquidity without losing your long-term investment. But before we dive in, make sure you hit subscribe so you team his future crypto tips, and drop a comment below. Would you ever borrow against your crypto instead of selling it? All right, let's get started. All right, to kick things off, we've seen crypto-backed lending grow exponentially in 2025. Many cryptocurrency holders are now looking beyond simply buying and holding and want to make their crypto work for them. Some see loans as a way to tap into their crypto's value without giving up ownership in others. Use loans to diversify their portfolios by investing in new opportunities. So let's get into some specifics. First, what are crypto loans? Crypto loans allow users to borrow cash or stablecoins like USDT or USDC by putting up their crypto assets such as Bitcoin, Ethereum, or other digital assets as collateral. These loans give users access to their crypto's value without having to sell any of their holdings. And here's a term to know. Loan to value, or LTV, refers to the percentage of the collateral value that the platform is willing to loan against. For example, if a platform has an 80% LTV and you put up $1,000 worth of collateral, you may be able to borrow $800. Now you might be wondering why not just sell your crypto? Well, there are several reasons why crypto loans have become increasingly popular. First, long-term value potential. Many investors believe that cryptocurrencies like Bitcoin and Ethereum still have tremendous upside potential. By not selling, investors can maintain their exposure and benefit from any price appreciation. Second, avoiding capital gains tax. In many jurisdictions, profits from cryptocurrency sales are treated as capital gains for tax purposes. This means that investors must pay taxes on any profit they make from selling their crypto. By not selling and using loans instead, investors can defer these taxes. Third, keeping exposure to bull markets. When investors sell their crypto, they may miss out on any subsequent price increases. By not selling and keeping their investments in the market, investors can continue benefiting from market rallies. Finally, using loans for trading and investing. Crypto loans can also be used to purchase additional cryptocurrencies, diversify portfolios, or invest in other opportunities. Now that we know why people are interested in crypto loans, let's differentiate between centralized and decentralized crypto loans. CeFi platforms are centralized finance platforms that offer crypto loans. Some popular examples include BlockFi, Nexo, and Binance loans. These platforms typically have lower interest rates and higher loan-to-value ratios than DeFi platforms. However, centralized finance platforms also present unique risks, since users entrust their assets to third parties. For example, in the case of BlockFi, customers had their crypto at risk when the company faced bankruptcy proceedings. On the other hand, decentralized finance, or DeFi platforms, enable peer-to-peer lending without intermediaries. DeFi platforms like AB, MakerDAO, and Compound often have higher interest rates, but also offer more control and flexibility to users. It's important to note that both types of crypto loans can be safe as long as you do your research and choose reputable platforms. Let's move on to how the process actually works. Generally, obtaining a crypto loan involves 4 steps. Step 1, deposit collateral. Users must first deposit their crypto assets on the platform as collateral. This could be Bitcoin, Ethereum, or other supported cryptocurrencies. Step 2, choose an LTV ratio. Once collateral is deposited, users select the loan-to-value ratio they wish to use. This determines the maximum amount they can borrow based on their collateral's value. Step 3. Receive stablecoins or fiat. After setting the LTV ratio, users receive a loan in either stablecoins or fiat currency, which they can then use however they want. In Step 4, repay the loan plus interest to unlock the collateral. To close the loan, users must repay the principal balance plus interest within the agreed-upon timeframe. Upon repayment, they regain access to their collateral assets. Alright, so you're thinking about getting a crypto loan, but you're not sure where to start. Let me share a few details on some of the best crypto loan platforms of 2025. Now, I won't endorse any particular platforms, but I will provide information on some of the most popular ones in the space right now. For example, BlockFi offers loans against Bitcoin, Ethereum, and other crypto assets with competitive interest rates and flexible terms. Another great option is Nexo, known for its instant loan origination and high LTV ratios. They support over 20 crypto assets and offer competitive interest rates. Lastly, Binance Loans allows users to borrow cash or stablecoins against their crypto holdings. They offer various loan options, including flexible and fixed terms. Each of these platforms has its own strengths and features. It's essential to compare them based on your specific requirements. Next, I want to highlight the biggest risk most people overlook when it comes to crypto loans: liquidation. Collateral can be liquidated if its value falls below a certain threshold. This means that if the value of your collateral drops significantly, the platform may sell your crypto to recoup its losses. For example, if you use Bitcoin as collateral and the price drops unexpectedly, the platform may liquidate your Bitcoin to protect itself. So it is important to monitor the value of your collateral closely and make sure it remains above the liquidation threshold. Another risk to consider is volatility. Cryptocurrencies are known for their price volatility, which can impact the value of your collateral. If the price of your collateral drops, you may need to make additional payments to bring the loan-to-value ratio back below the platform's limit. Otherwise, your collateral could be liquidated. You should also consider platform risks. While reputable platforms take measures to secure user assets, no system is completely immune to hacks or shutdowns. In the event of a hack or shutdown, users may lose access to their funds or experience delays in recovering them. Now that we covered the risks, let's shift gears and talk about the benefits of crypto loans. First, instant liquidity. One of the primary benefits of crypto loans is the ability to access liquidity instantly. Unlike traditional loans, which can involve lengthy approval processes, crypto loans often provide quick access to funds. Once your collateral is approved, you can typically receive your loan within minutes. Second, flexible repayment options. Most crypto lending platforms offer flexible repayment options, allowing you to repay your loan over time. This can be helpful if you have short-term cash flow needs or want to avoid a large lump sum payment. Third, useful for traders, investors, and entrepreneurs. Crypto loans can be beneficial for various individuals. Traders can use them for margin trading or hedging positions, while investors can leverage loans to diversify their portfolios. Entrepreneurs can also utilize crypto loans for business purposes, such as covering operational expenses or seizing new opportunities. And last but not least, let's discuss some best practices when it comes to crypto loans. Choose a reputable platform. It's crucial to select a well-established platform with a track record of security and reliability. Look for platforms with strong security measures and a history of responsible lending practices. Keep your LTV low. Maintaining a low loan-to-value ratio can help you avoid liquidation and reduce the risk of losing your collateral. Set an LTV that provides a comfortable margin of safety based on your collateral's price volatility. Diversify your collateral when possible. Using multiple crypto assets as collateral can help mitigate risk. If one asset's value declines, another may appreciate, providing balance to your collateral portfolio. So there you have it, a comprehensive guide to crypto loans in 2025. Hopefully you gained insight into what crypto loans are, why they're gaining popularity, how they work, the risks involved, and the benefits they offer. Remember, crypto loans can be a valuable tool for cryptocurrency holders, but it's essential to approach them strategically and understand the potential risks. Stay informed, keep your LTV low, diversify your collateral, and always prioritize your financial well-being. So what do you think? Would you ever take a crypto loan? Or would you rather just sell your coins? Drop your answer in the comments, and if you found this useful, hit that subscribe button, because I post weekly insights on crypto, DeFi, and the future of finance. Thanks for watching, and remember, your crypto can work for you, not just sit in your wallet. Thanks for watching, and remember, your crypto can work for you, not just sit in your wallet.